Okay, so you want to own a gym, sign a lease, line the walls with treadmills, and wait for the memberships to pour in. That's the version playing in your head. And honestly, it's a reasonable version. Walk into any gym around 6 on a Tuesday, and it looks unstoppable. Every machine occupied. The music competing with the clang of weights, a cluster of people waiting for the squat rack. You take one look and you think, this place is a money machine. More bodies, more signups, more cash. Easy. Here's the trouble. You're standing in the single hour of the entire week that tells you the biggest lie. The reality is that a gym isn't really a fitness business at all. It's a subscription business that happens to keep some barbells in the corner. And once that clicks, every strange thing about how a gym earns money and how it silently bleeds it suddenly lines up. Start with the cost of simply opening the doors, because that number is far messier than lease a room, order some machines. There's no single kind of gym. There are several, and each one is a completely different business, dressed in the same gym shorts. At the cheap end sit the budget chains, the $10 to $25 a month giants that stuff a warehouse full of thousands of members and win purely on scale. A single one of these can carry 5,000 to 8,000 members while running on a bare-bones staff. A step up is the standard commercial gym, weight floor, cardio row, a few group classes, usually $40 to $70 a month. Higher still, the premium clubs charging $150 a month or more, where you're really buying a lifestyle, saunas, smoothie bars, lounge chairs, the whole package. Then the boutique studios, tiny rooms sometimes under 3,000 square feet, built around one class format, charging $50 to $150 a month, or selling class packs. And finally, the small, unforgiving category, the personal training studio, sometimes just 500 square feet, that sells no memberships whatsoever. It sells hours with a coach. Every one of these is a different answer to the same question. Do you earn from a mountain of people paying a little, or a handful paying a lot? That one call decides every other number down the line. Now watch where the beginner's mental model cracks. You assume the equipment is the pricey part. It isn't. The pricey part is converting a bare shell of a building into somewhere that can legally hold a room full of sweating humans. A commercial landlord will typically want 3 to 6 months of rent up front as a deposit before you've touched a single wall. Then the build-out begins. Rubber flooring tough enough to survive a dropped barbell without shattering the slab underneath runs $10,000 to $40,000. Locker rooms and showers demand moisture-proof materials and real drainage, another $10,000 to $50,000. Mirrors alone, floor to ceiling, can hit $3,000 to $12,000 once they're up, and then the line item almost nobody plans for correctly: air. A basic retail space simply isn't designed to absorb the heat and humidity of a crowd exercising for hours. You need industrial ventilation, and the volume of fresh air you're legally obligated to pump in isn't a vibe, it's a formula. Building codes call for roughly 20 cubic feet of fresh air per minute for every person working out, plus a little extra for the floor space itself. Run that on a 5,000 square foot floor with 100 people on it at peak, and you're pushing over 2,000 cubic feet of fresh air every single minute. That's not a fan. That's a full HVAC overhaul, and it can cost anywhere from $10,000 to $50,000 before you've collected a single dime. Stack the deposit, the renovation, the permits, the insurance, the launch marketing, and a cash cushion to outlast the slow opening stretch. And even a modest mid-size commercial gym can demand $300,000 to over $1 million just to unlock the front door. So far, so good. Now let's talk about what breaks. Equipment is the next trap, and it's deeper than people expect. One commercial-grade treadmill costs $2,000 to $8,000. A gym needs 6 to 12 of them just for a basic cardio row. Weight machines run $1,000 to $5,000 each, and a real floor wants $12,000 to $20,000. Throw in racks, dumbbells, benches, and the odds and ends, and the equipment tab for a mid-sized gym lands somewhere between $40,000 and $250,000. Here's the fork in the road that snags people. Buy it outright or lease it. Buying feels safer. It's yours. It's an asset. No monthly bill hanging over your head. But buying drains your cash exactly when you're most exposed, in those early fragile months before members arrive in real numbers. And machines don't last forever anyway. Constant daily pounding grinds them down in a way a home garage never would. Leasing sounds clever. Small payments, cash stays free, swap the gear every few years so nothing looks tired. Lovely. Here's the catch. Equipment lease financing can carry an interest rate around 8% a year, which means over the term, you hand over noticeably more than the gear was ever worth. And the lease doesn't care how your gym is doing. If the memberships evaporate and you lock the doors, those payments don't die with the business. They follow you out onto the street. Neither choice is wrong, but whichever you take, you've just chained yourself to a big fixed cost that comes due every month, no matter how many people actually walked in that day. Now, location. This is the decision most first-timers botch, because they think a great location just means lots of people nearby. It's tighter than that. Around 80% of a gym's members come from within a 10 to 15 minute drive or transit ride of the door. That's it. That's your whole market. Not the city, not the metro, a 10-minute circle. And inside that circle, the incomes have to match your prices. A premium club at $150 a month can't survive in a budget income neighborhood, no matter how shiny the machines are. A high-traffic storefront in a big city can cost $25 to $120 per square foot per year in rent, versus $12 to $20 in a rural town. Land on the wrong side of that gap and you've locked into a rent bill that needs a membership base your neighborhood simply can't produce. Now we reach the part that explains everything else. The membership itself. Picture a coin toss, except instead of heads or tails, imagine everyone who signs up drops into one of two futures. In the first, they show up 3 times a week, every week, for a year. In the second, they come twice in January, feel great about themselves, and then vanish, while the payment keeps leaving their account. Which member is worth more to the gym? It's the second one. And that is the single most important idea in this entire business. So let's slow down and run the math. The person coming 3 times a week burns hot water in the showers. They wear down the treadmill belt. They need towels washed. They eat floor space during the exact busiest hour, which irritates other members and nudges them toward quitting. Every visit costs the gym a sliver of real money and a sliver of real capacity. The one who signed up in January and disappeared cost the gym almost nothing. No hot water, no towel, no wear, no crowd. In the cold language of economics, their cost to serve is basically zero. And while their payment lands every month like clockwork, nearly every dollar of it drops straight to the bottom line. Industry data keeps showing that around 2 of every 3 members rarely or never actually use the gym they pay for. Read that again. The bulk of a typical budget gym's revenue comes from people who aren't exercising there. That's not a glitch. That's the design. Think about the building. A gym with 6,000 plus members could never physically cram even a fifth of them onto the floor at once. The fire code forbids it, and there aren't enough machines anyway. A typical floor might be legally capped around 200 to 300 people at a time. If just 10% of a 7,000-member gym showed up together, you'd have 700 bodies fighting for a room built for maybe 250. The fire marshal would shut it down in minutes. So the gym isn't selling you a room. It's selling a statistical bet that most members won't show up at the same time, and a big chunk won't show up at all. The building only has to fit the fraction who actually come, not the total who pay. This is exactly why gyms don't secretly wish every member became a daily regular. A gym packed with daily regulars would need a far bigger, far costlier building with far heavier utility bills to serve the identical number of paying customers. The forgotten membership, the one quietly draining an account no one checks, is one of the most profitable customers a gym has. There's a seasonal twist worth walking through because it shapes the whole financial calendar. Roughly 12% of all yearly signups happen in the single month of January. Riding the resolution wave, gyms lean in hard, slash joining fees, cheap trials, a burst of ads jammed into a few weeks. That 1 month can hand an owner a huge slug of upfront cash and a fresh stack of monthly billing. But the tide that rushes in, rushes right back out. About half of new members stop attending within 6 months, and of the January resolution crowd specifically, up to 80% have quit showing up by summer. February is actually the riskiest month of all, the exact point where the motivation burns off before a habit ever sets. Seasoned owners don't flinch at this. They build their whole cash flow around it, using the January flood to bank a reserve that floats them through the quiet summer. The ones who get wrecked are those who spend that January windfall like it's the new normal, instead of the seasonal spike it really is. There's a structural choice sitting under all of this too. Build an independent gym from scratch, or buy into a franchise. A franchise hands you a known name, a proven floor plan, standard software, and often cheaper equipment through corporate deals. That's real value, especially for a first-timer. But it isn't free. Franchise agreements usually demand an upfront fee of $20,000 to $60,000, an ongoing royalty of 5 to 10% of gross revenue paid up the chain every month, and another 2% or so poured into a shared national marketing pot. An independent owner keeps every dollar of profit. A franchisee permanently shares a slice off the top in exchange for the brand and the support, which can absolutely be worth it, but only if the name pulls in enough extra members to cover what you're handing back. Now, here's where the psychology matters as much as the math. Why do people keep paying for something they never touch? Part of it is the optimism of signing up. The membership feels like a promise to a better future you. Part of it is what economists call a commitment device. Paying for the gym is supposed to be the thing that drags you there. And part of it is pure inertia. Canceling means admitting the plan failed, and for 10 to 30 bucks a month, most people would rather keep quietly paying than face that. The physical design leans into this whether anyone notices or not. Clean, open layouts with obvious pathways cut the intimidation a newcomer feels on their first walk-in, which keeps them coming back long enough for the habit to either stick or quietly die. Mirrors around the weights let people track progress, which can lift motivation, but too many mirrors in a beginner zone backfire and crank up self-consciousness instead. Even the lighting is deliberate. Weight rooms often use harder, angled light that carves out muscle definition, while stretching and recovery corners use softer light to feel calmer. Even the music tempo is picked on purpose, since faster tracks help people grind through a set with less perceived effort. None of it is decoration. It all aims at one target, keeping a member emotionally tied to the gym as long as possible, whether or not they ever come in. And gyms know this, which is exactly why leaving is almost never as smooth as joining. Plenty of contracts make you cancel in writing, not by phone, not through an app, but in person at the club, or by certified mail with a return receipt. Contracts often demand 30 to 60 days of notice before the next billing cycle, which guarantees the gym scoops up at least one more month even after you've decided to walk. And when a card expires or a payment bounces, that alone drives roughly 30 to 40% of all cancellations, which is why gyms run entire teams devoted to chasing failed payments before a member slips away for good. Regulators have noticed the friction. The Federal Trade Commission tried to roll out a national rule in 2024 requiring that canceling a subscription be as easy as signing up. A federal appeals court struck it down on procedural grounds in the summer of 2025, and the agency restarted the process. Some cities moved on their own. New York City, for one, brought in a local click-to-cancel rule. Flag, I'm confident about the FTC rule timeline and NYC level action, but I'd verify the exact NYC effective date and per violation penalty figure before publishing, as I'm not certain of those specifics. Keep this in mind, because it says something loud about the business you're eyeing. If a gym's survival truly rested on happy, engaged, frequent members, it wouldn't need to make quitting this painful. The fact that cancellation friction is baked so deeply into gym operations tells you the business already knows a huge share of its revenue comes from people who wish they'd stopped paying. Before we get to the big failures, there's a second layer of hidden costs that ambushes nearly every first-time owner, and it has nothing to do with treadmills. It's the music. Playing background music in a business isn't the same as playing it in your kitchen. In the United States, any business playing music for its customers is legally required to pay for a public performance license. And there isn't one place to pay. There are several performing rights organizations, each representing different songwriters and publishers, and a gym usually has to be licensed with more than one at once. The minimum annual fee for each can run from around $200 to nearly $600, and once you're covering all of them, the combined bill for one location can sit somewhere between $1,300 and $4,000 a year. Skip it, and the downside is brutal. These organizations send field investigators into gyms, bars, and shops specifically hunting for unlicensed music. Under federal copyright law, statutory damages for infringement can run from $750 per song up to $30,000, and as high as $150,000 per song if a court finds it willful. An owner who assumes a personal streaming account is fine for the sound system has quietly taken on a legal risk worth far more than the license ever cost. That's a small example, but it points at the real lesson of this whole business. Almost none of the true costs are the ones on the equipment catalog. They're buried in a licensing agreement, a lease clause, a maintenance contract nobody reads until something snaps. And plenty snaps. Constant use grinds down treadmill belts, cable machines, and upholstery far faster than home use ever could. And mid-sized gyms typically budget $1,000 to $3,000 a month just for ongoing repair and replacement. Utility bills for a building running non-stop ventilation, bright lights, and hot showers can run $1,000 to $6,000 a month. None of these numbers are scary alone. Stacked month after month, they quietly chew through the exact margin the owner was banking on. Now, can a gym built entirely on this quiet subscription model actually survive? Because the honest answer is sometimes no, even at massive scale. Meet Bally Total Fitness. At its peak, it was the biggest health club chain in the country, with locations nationwide and a model built on aggressive long-term contracts, often financed over years, like a car loan. On paper, it looked genius. Chain members to years of guaranteed payments, and you've locked in your revenue in advance. So how does the largest fitness chain in America end up filing for bankruptcy, not once but twice, inside a single year? The answer isn't that people quit wanting to exercise. It's structural. The aggressive sales tactics and long-term financing triggered consumer protection lawsuits and accounting investigations. The company had built its empire on debt and contractual promises, rather than real, durable member value. When the legal and financial pressure piled up, the whole thing buckled. Bally filed for bankruptcy in 2007 and again in 2008 before its assets were carved up and sold off. A similar story hit 24-Hour Fitness, once one of the largest chains in the country. It didn't collapse because people stopped working out. It collapsed because it carried too much debt against its actual cash flow, and when that debt came due, sheer size couldn't save it. Here's the structural takeaway, because that's the real point of both stories. Neither company died because nobody wanted a membership. They died because the math linking fixed costs, rent, debt, equipment financing, to reliable revenue fell apart. A gym with thousands of members and a full parking lot can still be one bad debt structure away from insolvency. The crowd on the floor tells you nothing about whether the finances underneath can hold. So mechanically, how does a gym actually make money once it's past all this? The core engine is simple. Monthly dues, times members, minus fixed costs. If a gym carries fixed monthly costs, rent, payroll, equipment payments, utilities, insurance, software, of around $30,000 and charges an average of $89 a month per member, it needs roughly 337 paying members just to break even. Below that line, it loses money every month. Above it, each extra member is nearly pure profit because remember, the marginal cost of an inactive member is close to zero. That's the good news. Here's the volatility right behind it. New gyms almost never hit break even on day one. It can take 12 to 18 months of stacking members before the place crosses into profit, and every one of those months eats into the reserve the owner set aside. If the pre-opening sales push is weak, or a competitor opens nearby during that window, the runway can run dry before the gym ever earns a cent. And membership isn't a stable, ever-climbing number. The industry average for annual churn, the share who cancel each year, sits around 30 to 40%. A gym with 500 members losing 5% a month has to sign roughly 300 new ones over a year just to end up exactly where it started. That's not growth, that's sprinting on a treadmill. This is where a second revenue stream becomes essential, and it's the one with genuinely strong economics. Personal training. A trainer working one-on-one can only reach so many people. At a typical rate around $80 a session, capped near 25 sessions a week to keep the trainer from burning out, across 50 working weeks a year, a single one-on-one trainer tops out around $100,000 in annual revenue. That's a hard ceiling. You can't add hours to a day. The way past it is training several people at once. A coach running a semi-private session with 4 clients, each paying $40, pulls in $160 for that 1 hour, roughly double the one-on-one rate, while each client individually pays less than private coaching. That's why so many gyms have leaned into small group formats. It smashes the one trainer, 1 hour, 1 client ceiling that caps pure personal training. Of course, the gym doesn't pocket all of it. Trainers on payroll usually take 30 to 50% of what they bring in. If a session bills at $75 and the trainer keeps half, the gym holds $37.50 to cover space, gear, and margin. Still, across a full client roster, personal training is far more profitable per hour than a plain membership could ever be. One committed training client can be worth dozens of members who barely swipe their card. Now let's stack it all together over a full year, because this is where 2 very different versions of the business step into the light. In the optimistic case, you picked the right neighborhood, hit break even on schedule, kept churn on the low end, and built a healthy training program beside your membership base. Under those conditions, a mid-size independent gym can pull in somewhere between $500,000 and $1.5 million a year in revenue, at a net margin of 10 to 20%. That can mean an owner take-home of roughly $70,000 to $180,000 a year, a genuinely solid return for the work and capital. In the realistic case, 2 or 3 things go sideways, and none of them are exotic. They're just the ordinary risks of this exact business. Churn runs at the high end instead of the low. A budget chain opens 2 miles away and siphons off your price-sensitive members with a cheaper rate. Equipment starts breaking more than expected, adding another $1,000 to $3,000 a month to overhead. Under those conditions, that same gym can slide from a comfortable double-digit margin into single digits, or into an outright loss during a slow stretch, even while the parking lot still looks decently full most evenings. The gap between those two outcomes in a single mid-sized gym can be well over $100,000 in 1 year. And almost none of that swing shows up as a dramatic event. No fire, no scandal, just a slightly higher cancellation rate, a slightly slower ramp, a slightly heavier repair bill, compounding quietly month after month until the number at the bottom of the spreadsheet looks nothing like the plan. So if you do decide to open a gym, hold on to the one thing that actually decides whether you make it. It was never really about how many people you can get to sign up. It's about how well you can survive on the people who stop showing up.